Hey traders, welcome to another episode of NF Trader. Today, we're diving deep into fair value gaps. We'll uncover the lesser-known truths behind them and explore advanced concepts. Let's get right into it. Fair value gaps, or FVGs, have become a major focus in the trading world lately, and for good reason. When used correctly, they can be incredibly effective. But here's the thing, not every FVG plays out as expected. For example, one setup might fail completely, while another plays out perfectly. So, what makes the difference? Why does one FVG hold and another break? Well, there's actually a powerful filtering technique I use that helps me identify which fair value gaps are more likely to hold. Once you start applying this method, you'll notice a significant improvement in your FVG accuracy. Before we get into that, let's break down what a fair value gap really is. These imbalances can occur in both bullish and bearish directions. Essentially, a fair value gap forms when the market makes a strong, sudden move, usually shown by a large candle with little to no resistance. For example, imagine price surging upwards rapidly, forming a big green candle. The move happens so quickly that sellers don't have time to react. This creates a price imbalance, a gap where the market didn't have a chance to trade fairly. Typically, price will want to revisit that zone to balance things out. To identify this area, you can mark the wick of the candle before the big move and the wick of the candle after it. The space between is your fair value gap. If you scan your charts, you'll notice these gaps appear often. Many times, price will return to this zone, fill the gap, and then continue in the original direction. This provides a solid opportunity for traders to catch profitable moves. But, and this is key, fair value gaps aren't foolproof. They don't work every single time. That's why understanding when an FVG is actually valid makes all the difference. Not every FVG will work. Some get respected beautifully. Others, price rips right through them. So the question is, what separates a valid FVG from an invalid one? Let me show you the 6 criteria I use to filter out low probability gaps and how you can apply them too. Number 1 is aligned with higher time frame context. A valid FVG must be in the same direction as the higher time frame structure such as 4-hour or daily. An FVG formed against the higher time frame bias is less likely to hold. Let's go through an example to understand this better. We're looking at the 4-hour chart of pound. As we can clearly see, price is in a strong uptrend. After a liquidity grab, price retraces into a 4-hour FVG. Since the overall structure is bullish, we expect the price to continue higher from this area. Now, let's drop down to the 15-minute time frame. On this lower time frame, we observe a change of character, which shows that buyers are stepping in. Following this change of character, a 15-minute FVG is formed. Here's the key part. Because this 15-minute FVG is in alignment with the 4-hour bullish trend, it's considered valid. The structure and momentum on both timeframes support the same direction, upward. That gives us a higher probability setup, and we can look to take a long entry from this FVG. This kind of multi-time frame alignment increases the chances of a successful trade and helps us avoid counter-trend setups that often fail. On the flip side, if the higher time frame is bearish and you try to take a long off a bullish FVG, you're going against the current. That FVG is much more likely to fail or offer a shallow reaction. Tip: always analyze from top down, start with the daily or 4-hour chart, and make sure your setup agrees with the bigger picture. Rule 2. The FVG must be unmitigated. In simple terms, that means price should not have returned to that zone after the gap was formed. The whole idea behind a fair value gap is that price moved too quickly in one direction, without giving the other side a chance to react. That zone needs to remain untouched, that's what makes it powerful. Let's walk through an example using the Euro chart. Here, we're clearly in a strong downtrend. At some point during this move, a clean fair value gap forms in the direction of the trend. Price pulls back beautifully into this FVG and reacts strongly. That's exactly what we want to see. The FVG gets respected, and price continues its move downward. However, later on, price returns to that same FVG again. This time, the reaction is much weaker. In fact, the level fails entirely. Why? Because the FVG has already been mitigated. The first touch absorbed the resting orders and rebalanced the price action. By the second return, there's no imbalance left, and as a result, the zone no longer holds. Number 3. The FVG must lead to a break of structure or change of character. After the FVG forms and price reacts to it, we want to see a clear market shift, either a BOS or change of character, to confirm that the move is real and not just a bounce. Suppose price returns to a bullish FVG, reacts, and then breaks the previous high. That's a bullish break of structure. It confirms the buyers have taken control and the move is likely to continue. Let's take another example from this chart. Here, the market is in a clear downtrend. At one point, an FVG forms during a pullback. However, after price reacts to this FVG, we don't see any meaningful shift in structure. Price fails to break the previous low, so there's no BOS. It also doesn't manage to break the previous high, so there's no change of character either. Because we don't get any of these structural confirmations, the FVG has no real support behind it, and as expected, it gets invalidated and fails shortly after. This is why structure is key. An FVG without a BOS or change of character is like a signal without confirmation, risky and unreliable. Structure is king. Never ignore it. A valid reaction must show intent, and that comes through structure breaks. Rule 4. Located in a premium or discount zone. Context within the price range matters. In a bearish market, you want to trade bearish FVGs located in the premium, overbought area. In a bullish market, focus on bullish FVGs in the discount, undervalued zone. Say price is in the premium zone of a bearish swing and forms a bearish FVG. That's ideal. Smart money often sells from premium. But if that same FVG formed in the discount, it's less likely to hold. Okay, number 5 is liquidity grab before the gap. Smart money doesn't just create imbalances randomly, they often sweep liquidity right before creating a valid FVG. Price breaks below equal lows or takes out a major swing low, grabbing liquidity, and then immediately forms a bullish FVG. That's a strong indication of a liquidity sweep and imbalance combo, which makes the FVG much more likely to hold. Always ask, did price take liquidity before this move? If yes, the setup just got a lot more interesting. And number 6, liquidity building around the FVG. Even if price hasn't tapped into the FVG yet, pay attention to what it's doing nearby. If price is consolidating and building equal highs or lows near the FVG, that makes the zone even stronger. Say you have a bullish FVG, and price is hovering just above it, forming equal lows. That's a sign that liquidity is building. Smart money may push price down, take out those lows, tap the FVG, then reverse sharply. Liquidity acts like a magnet. When you see it sitting near an FVG, that zone becomes very attractive for smart money to react from. Fair value gaps are one of the most powerful tools in the smart money toolbox if you use them correctly. Mark the gaps, but filter them. Trade with structure. Trade with logic. Trade with patience. If this video helped you level up your FVG game, drop a like, and subscribe for more breakdowns like this. Got questions or want a part 2? Let me know in the comments. See you in the next one.